What if I told you that your 401k is not the safest way to retire wealthy? Take a read. According to a new study by Schwab, 57% of 401k investors are not confident that they'll be able to retire comfortably. Why? Because workers expect to retire at age 66 and believe that they'll need $1.6 million saved. And unfortunately, that's not happening. The average 401k balance for somebody aged 55 to 64 is $272,000. And for somebody over 65, the average 401k balance is just under $300,000. But the median balance is even worse. The median balance for somebody 55 to 64 and for somebody over 65 is just $95,000. For millions of Americans, your 401k is not going to be enough. And when you couple that with 401k fees that most people are not factoring in and add in inflation slowly chipping away at the value of your 401k, you can start to see the problem. But that ends today because in this video, I want to help you flip that 401k trap. That way you can turn it into a wealth building machine. Let's start by zooming out. This is you and you want to get here: retirement, financial freedom, wealth, call it whatever you want. And the way that you get there is through this vehicle. Now, a lot of people assume that the only vehicle to take you there is your 401k. But your 401k is one investment vehicle, and a lot of people are driving around in this Toyota Camry when you can turn it into a Lamborghini, just by understanding how to use this vehicle better to get you to a bigger retirement or to get there even faster. One of the biggest mistakes that people make in this process is they just start driving without knowing where they're actually driving to. They don't have an actual destination. So let's start with the end in mind. What is your goal? What is this retirement? What does this wealth look like? And there are two parts to this. One is the financial part, how much money do you need? And number two is the non-financial part. So let's break this down. Let's start with how much money you need. Now, the traditional rule here that pretty much every financial advisor will tell you is the 4% rule. Now, I'm personally not a huge fan of this. I'll talk more about that a little bit later. But what the 4% rule says is figure out how much money you would need to survive and live your life comfortably for 12 months. Then take that number and divide it by 4%. So hypothetically, let's say you want $5,000 a month or you need $60,000 a year to be able to live your life financially comfortably. You take that $60,000, you divide it by 0.04 or 4%, and that means you're gonna need about $1.5 million to be able to retire comfortably. The idea being that you'll be able to pull 4% out, that's $60,000 a year, and adjust it for inflation, meaning take out more money the year after that and the year after that, every year, and you should have enough money until you die. That's the 4% rule to figure out how much money you need. The other part to this is, well, what happens if you do this right? You build this Lamborghini really quickly, and you can get to this financial number a lot sooner than expected. If you hit this $1.5 million number tomorrow, what are you gonna do? Now you might say, well, Jaspreet, I'm gonna travel the world and I'm gonna do all the things that I've been wanting to do. Okay, you do that for 6 months. You do that for a year. Then what? There's a saying, those who retire early die early, because what a lot of people end up doing is they work a job that they hate for 30, 40, 45 years, then you quit. All you're used to doing is working, and now you have nothing to do. You have money in the bank, so you go to the sofa and you turn on the TV and you sit there and you watch the stupid box, the TV, all day and night long, and then you let your brain rot. So I want you to start thinking about this, because you might be seeing this with your parents, you might have seen it with your grandparents or your uncles or aunts or other people, where when you get older and you hit that retirement number and now you just sit there doing nothing, it's not good for you mentally, physically, spiritually. So what is it that you would do if you had that money sooner rather than later? That way you can start building your dream life, and then when you have the money, you can start actually funding that dream life too. So now you've set the goal, you've set the destination, you know where the GPS has got to go. Now, how do we actually go from here to here? What are the vehicles to get there? And for most people, there are only two vehicles to get somebody from this point to here. Number one is your 401k, and number two, can you guess what it is? This is your house. You buy a house, you pay it off, and now you have this house free and clear plus your 401k, and hopefully these two vehicles will take you to retirement at a young enough age. The problem that we're seeing happen today is that the people that have followed this traditional path, just have a 401k plus your house plus maybe Social Security, that way you can retire comfortably, is failing. We are seeing the biggest retirement crisis in American history because these vehicles are not getting people to where they need to be financially for retirement. I mean, we can just do the math. This is the mistake that millions of Americans are making while they're thinking they're doing the right thing. So let's say you work a job, you're making $60,000 a year, a pretty good income, and your company offers a 100% match on your 401k contributions up to 4% of your income. So what do? So now you say, well, that's some free money. So how about I invest 4% of my salary? 4% of $60,000 a year is $2,400 a year that you decide to invest, and then your company doubles that because they're going to match a contribution up to 4%. So your company gives you an additional $2,400 a year that is going to go into this vehicle, your 401k, to help you get to that retirement. So that means you are investing effectively $4,800 a year, and this is what many people call free money, and you hope that this is going to help you get to that retirement number. Well, let's do the math. The average 401k account is growing by 5 to 8% a year. And I'm going to be generous. I'm going to assume that you started getting financially savvy when you were young. So you started investing in your 401k when you were just 25 years old, and you did it for 40 years. You continued investing your money until you were 65 years old. If you got the higher end of returns in the average 401k, which is 8% a year, that means your money would have grown to $1.25 million. But if your returns are not as good as the high end of average and you only got a 5% return, now that means your money only grew to $580,000. Now you can start to see the problem. If you got the higher end of returns, the $1.25 million, you're still quite a bit of ways away from what you needed, the $1.5 million. But there's one bigger problem that a lot of people are overlooking here. This is taxed. Because if you put all of that money in, if you put all of your 4% of your income in, and that means that money was not taxed when it went in, the money grew tax-free, you have to pay taxes when the money comes out. This is how a traditional 401k works. If you used a Roth 401k, well, that means you pay taxes when the money goes in. So now instead of you investing $2,400, you would have invested a fraction of that, maybe 10 or 15% less than this, because, well, you have to pay taxes first. So in this example, with the traditional 401k, you got $1.25 million in here, but when you pull this money out, you have to pay taxes, which means you are left with even less money than here, which leaves you further away from your goal. But then you tell yourself, well, Jaspreet, wasn't I making monthly mortgage payments every single month? Isn't that building equity in my house? And kind of, except the way that banks work is they follow what's called an amortization calculator, an amortization schedule, which means that they front load your mortgages. So if you're paying $1,800 a month because you financed a $300,000 house, that doesn't mean that $900 is going to principal, meaning building equity, and $900 is going to interest. What actually happens is most of your $1,800 payment is going to interest for the first number of years on your mortgage. Take a look. If you got a $300,000 loan at a 6% interest rate, that $1,800 a month that you're paying is going primarily into your banker's pocket with interest. It's not until year 19 of your 30-year mortgage that half of your monthly payment is going to principal, building equity in your house. Now hear what I'm saying very carefully. I'm not saying it's bad for you to own a house, but if this is your goal is to get to this financial retirement, this financial wealth, this financial freedom, whatever the heck you want to call it, this is the number you need. How can you accelerate these vehicles? That way the money you're putting towards your investments can get you here faster. So let's break that down. And this is where I do want to remind you that if you are an investor or want to become an investor, my team and I have put together a brand new free investing masterclass where I will walk you through how you can get started as an investor and find hidden investment opportunities before everybody else. And I'll share the exact framework that my firm uses to research investments and find investments before they hit the headlines. It's a completely free masterclass. There's a ton of value in there. And when you register for the masterclass, you're also going to get access to Market Briefs, which is my newsletter for investors, for free, just as a complimentary bonus. So if you want to get the Investing Masterclass and Market Briefs all for free, all you have to do is click the link down in the description below to register. So here you are. By the way, for my male followers, I drew a mustache, which in my native language Punjabi we call a much. For my female followers, we drew a braid, which in my native language Punjabi we call a gut. You are here. You want to get to this destination, you punch it into your GPS, and now instead of picking the route with the most tolls and the longest route, you want to pick the fastest route possible. And when you want to get the fastest route possible, unlike a GPS, you can have multiple vehicles to help you get there even faster, but you can also work to supercharge these vehicles. So if we want to supercharge these vehicles to get you to that retirement number even faster, we have to understand the limitations here. That way you can find alternative options to supplement these to help you get to that retirement faster and easier. So most of your mortgage payment is going to go into your banker's pocket in the form of interest for the majority of your loan. Then number two is you have to think about property taxes and interest. When you buy a house, not only do you have to keep up with the house, but you also have to pay property taxes and interest. And the reason why I bring this up specifically is because let's say you buy a house in a good area. You buy it for $300,000 and now this house is worth $1 million. Many people would say that you have hit the jackpot. But there's a couple things you have to remember. Number one, now that your house is worth $1 million, you have to pay property taxes on $1 million house. You also have to pay to insure $1 million house, which means that your cost of living in the house have now skyrocketed because your property taxes are more expensive and your insurance is more expensive. And if you can't afford it, well, that's the reason why many people have to leave their house, because they've seen property values go up so much and they cannot afford the carrying cost on those more expensive houses. Now, if you wanted to pull money out of the house, you have to do a cash out refinance, but then you have to still work to make those payments again. Number three, you have to think about cash flow. When you own this house, you don't actually get any money out of it unless you sell it for a profit. Again, the alternative is to pull cash out using debt, but then you have to pay that money back plus interest. So you're not actually making any money until you sell, but it's all invisible equity. You think that your house is worth $300,000, $500,000, but it's really only worth what somebody else is willing to pay. And that's where a lot of people have this wealth tied to the value of their house. But if the economy crashes when you actually need the money, that could put you in a pretty bad predicament. That's why I'm not against you buying a house, but I'm against people using their house as a wealth building machine. Use your house as a place to live. Pay it off. Great. So you don't have to worry about the mortgage payment. But thinking of your house as a way for you to build wealth is a very losing transaction, and that's not the way the wealthy people think. Number two, with the 401k, let's talk about the limitations here. Limitation number one with the 401k is you have limited options as to where you can invest. You can invest your money into the funds that the company has approved of that you can invest your money in. So maybe it'll be a few funds, maybe it'll be a lot of funds, but it really depends on which company that you have and what options that they have. Number two is fees. When you invest your money in these funds, you have to pay a fee. And because you have limited options, you might not have a ton of variety in how much these fees are. A small little 1% annual fee can cost you not 1% of your total returns, but 25 to 28% of your total investment value. So if you thought you were going to have $1 million after a 1% fee, you're going to have something around $750,000. By the way, yes, if you have a 401k, you are paying fees. It's called an expense ratio. So your homework after this video is to go and see what the expense ratio is on your funds. And then number three is you cannot touch your 401k until you turn 59 and a half years old. If you touch it before then, you have to pay a penalty. So there are a lot of limitations with the 401k. Again, hear what I'm saying very carefully. I'm not saying you should not use a 401k. I'm not saying a 401k is bad. I'm saying it's one vehicle, but it's not the only vehicle. And this is where a lot of people get stuck, is because they assume, because everybody else is doing it, that these two vehicles are the best path to retirement. The problem with that is majority of America is using these two vehicles, and the majority of America are facing a retirement crisis. So how do we now amplify this? There are three factors that will determine how wealthy you will become. Those three factors that will determine it are TRM, time, return, and money. The more time your money has to compound and grow, the wealthier you are going to become. The better returns that you can get, meaning how fast you can double your money, the wealthier you're going to become. And how much money you invest, well, is also going to determine how wealthy you become, because if you can invest $1 million to start, you can become more wealthy. Now, the one factor we cannot change is time, because you cannot start investing 5 years ago or 20 years ago. So you need to start investing sooner rather than later. So I'm not going to talk about time. Let's talk about returns. Starting with your 401k, if you want to get better returns, one thing that you can do is just analyze your funds. And the mistake that a lot of people make is they just throw their money into whatever fund is recommended without even knowing what that fund is. And sometimes they're overpaying on fees. So check the fund's history, because pretty much every company in the United States is going to give you access to high cost and underperforming funds that are going to eat away at your chance of getting the retirement that you want. And if you don't believe me, read this. 99% of 401k offerings were found to have at least one fund with the cheaper, higher performing alternative available to plan participants. So yes, not all funds are made the same. Spend 30 minutes doing some research, and if you don't know how, just throw it into ChatGPT and have it help you figure out how you can supercharge your 401k with less fees and higher potential growth. And if you are going to take some more speculative investments in your 401k, just understand the risks that you're taking with that. So you want to supercharge this? Know which funds that you're investing in. Well, what else can you do? Let's add some different vehicles here as well, because the mistake that a lot of people make is they're only investing a few percent of their income into these vehicles to get them to retirement. But we know that if you invest more money, you can get that wealth even faster, and there are other vehicles that you can take as well. For example, you can invest your own money into the stock market outside of your 401k by opening up your own self-directed account. You can go to something like Robinhood, something like Charles Schwab, something like E-Trade. I'm personally not a huge fan of Robinhood. I've never used it myself, but there's a lot of gamification happening with Robinhood that it just doesn't seem very professional if you actually want to be investing your money. Not trading. Robinhood's probably really good for trading, but if you want to be an investor, look for something like E-Trade or Schwab, or something that caters to a little bit more of a professional investor. Another option that I really like is M1. M1 is really good for passive investors. So if you're investing your money into ETFs, M1 has a system where it just automatically invests your money for you into these ETFs, and you can set the cadence every 1 week, every 2 weeks, every 4 weeks, and you just set it and forget it. So there are a lot of ways now for you to invest your money into stocks, whether it's individual stocks or funds outside of a 401k. That way you can contribute more money to get you to the wealth even faster. Another option is real estate. Now notice what I said here, real estate. I'm not talking about the house that you live in. I'm talking about buying properties to rent out to other families. This is very great for building wealth because now you're generating cash flow. The rent that you're getting, if you do it properly, should cover your property taxes, your insurance, your maintenance fees, your vacancy costs, and put some money in your pocket every single month. That way now when your property taxes go up, it's your tenants that are paying that higher cost, and you're getting paid that cash flow. And if the property values go up too, well, that's just extra icing on the cake for you. It can be a very great investment opportunity, but it takes more work, it takes more time, and it takes more money to get started. But it has built a lot of wealth for a lot of people. Not to mention that real estate has some of the biggest and best tax breaks that our tax code has to offer, which is why you have a lot of people earning huge sums of money in real estate. Hundreds of thousands of dollars a year, millions of dollars a year, and paying little to no money in taxes legally, because that's what the tax code says. In fact, there are ways that you can hack this as well, that if you're thinking about buying a house, well, there are ways to do it strategically. That way you can turn the house into a rental, or maybe you buy a duplex or a 3-unit or a 4-unit property as your primary residence, and you rent out the other units. That way now it's your neighbors that are paying your mortgage for you. So if that's something you're interested in, you can also generate cash flow, but do it strategically. That way you can use your house to actually help you get to that retirement number even faster. Now let's come back to this vehicle right here, talking about stocks. There are some ways that you can turn this into something that's a very high performing car, or go very slow, and you get to decide how aggressive you want to be. For example, you can invest in blue chip companies. These are larger companies that have been more established. Well, these huge multi-billion or trillion-dollar companies are generally not going to grow as fast as your smaller startups, because a multi-billion-dollar company or a trillion-dollar company doesn't need to grow as fast. They might just want to see slow and steady growth. That way they can just keep steadily growing. That's going to be their goal. But for a smaller startup company, they don't want to grow by 3% a year or 4% a year. They want to grow by 20% a year, because they want to gain market share and they want to change the world and really be one of the big behemoth companies. But that's going to be more risk for more potential return. So when you're investing in stocks, you can decide how much risk you want to take. You can find the more riskier type of investments that have the potential to grow a whole lot faster than the market, but they could also go bankrupt. Or you could take it a little bit more less risky, invest into more of the stable, strategic companies that have been around for a long time and see less growth, but have more steady growth and less risk. This is where it is so important for you as an investor to understand that it is in your hands. Just like when you're thinking about your health, don't just blindly listen to what a random doctor says. Research how can you take better care of your health based off of what is your lifestyle goals. It's the same with your money. You have to figure out how you can take the best care of your finances and not just blindly dump your money into a 401k and hope that that's going to be enough. Because the reality is it costs money to eat and it costs money to feed other people. You have to get serious about your finances, otherwise you're going to be the one that pays the price, and we're seeing that happen to millions of Americans today who don't have enough money to retire and having to work longer and don't know how they're going to be able to ever stop working. If you don't want to be in that position, start planning early. Think about what you need to do to get to that number. What is that number? What are the different vehicles that can get you there? And also don't forget about the non-financial part. If you get to the number even faster, because now you've built more vehicles, you started to supercharge them, well, what do you do now that you have the money and you have more time? And I want you to start thinking about that. That way you can live a happier life and a more fulfilled life and give back in a way that helps serve you and your purpose. Again, if you want some additional resources to help you get started as an investor, I have a free investing masterclass for you down in the description. And if you got value out of this video, the best thank you is a referral. So if you could, please share this video with a friend, a family member, a colleague, or a fellow investor. The United States government owes more than $37 trillion. That means your tax dollars are being used to pay interest on all that debt. And this is where President Trump has been proposing a new plan to help pay off this debt involving gold and involving crypto. And most people have no idea of how this plan works or the implication of this new plan on your money.